The US government shutdown cancels the release of key US jobs data. ANZ Research has raised its inflation forecast for Australia and now sees the Reserve Bank of Australia delaying its final rate cut until February. That's coming up in our 5 Things in 5 Minutes on Monday, October the 6th. And then in our deep dive interview, ANZ Senior Rate Strategist Jack Chambers explains where Australian inflation is heating up and why the RBA is likely to wait until after Christmas.
We just think inflation will be too uncomfortably high to justify that cut in November.
But first, in 5 and 5 with ANZ, a rare thing happened on Friday. A key piece of data for understanding where the world's largest economy is going just didn't turn up. US non-farm payrolls data on jobs growth and unemployment was not released as scheduled on Friday because of the US government shutdown, which is extending into its 4th day. ANZ Senior Rate Strategist Jack Chambers says markets and the Fed aren't quite flying blind, but the fog is descending.
It's payrolls along with the monthly CPI data in the US. Consistently the most important data we get, and it's hard to find a good alternative. We saw other labour market data for the US released last week, things like the ADP private payrolls release, which was actually very soft. It's not that the Fed is flying blind when it comes to the US economy, but we have much less information, especially at this point in the cycle, where we have inflation is higher than the Fed would like.
In markets over the weekend, the S&P 500 closed flat and the Nasdaq fell 0.3%. The US 10-year Treasury yield rose 2.9 basis points to 4.119%. Gold rose 1% to $3,908.90 US an ounce. That's its first ever close over $3,900 an ounce. West Texas oil futures rose 0.8% to $60.88 US a barrel, but that was before news last night that OPEC Plus will increase output by only 127,000 barrels in November. That was the same as October. The US dollar index fell 0.1%. That saw the Aussie dollar rise 0.1% to 66.04 US cents. And the Kiwi was up 0.2% at 58.32 US cents. Number 2. Jack says ANZ Research is sticking with its view the Fed will cut at each of its next 4 meetings.
We've had quite a lot of softness in the US labour market, particularly over the last 3 months. And we really kind of need to know, is that going to bounce back? We've seen consumption in the last few months in the US actually bounce back. You'd think usually that would be consistent with maybe a bottoming in the downswing in labour market conditions, but we just don't really know at this point. So it makes the Fed's job at this juncture a bit harder when they have a bit of a trade-off going on between softer labour market, slightly too high inflation, what the appropriate policy path is. We still think that the Fed will ease at the next 4 FOMC meetings, so another 100 points of cuts, but it does make their job a bit more challenging in the absence of the top-tier data.
Number 3. ANZ Research has increased its forecast for Australia's trimmed mean inflation in the September quarter to 0.9% from 0.7%. So it's changed its view on when the last rate cut by the Reserve Bank of Australia will be. It had previously seen a cut from 3.6% to 3.35% in November. Now it sees that cut in February. Here's Jack again.
So we haven't changed the terminal cash rate, 3.35, but we've pushed out the timing of the last cash rate. We just think inflation will be too uncomfortably high to justify that cut in November. And the labour market has shown a few signs of softening with weaker hiring growth in Australia, but not so much that it will affect the RBA's decision with the uncomfortably high inflation.
Number 4. Japan is about to get its first woman Prime Minister, with Sanae Takaichi winning the presidency of the ruling Liberal Democratic Party on Saturday night. She said after winning, she wanted the government to take the lead on monetary and fiscal policy, and her priority was to reflate demand in the broader economy. She also said it would be premature to declare victory over deflation. This has been seen as making a rate hike by the Bank of Japan less likely. Here's ANZ Head of FX Research, Marjabin Zaman.
Sanae Takaichi winning the leadership race for the LDP party will likely lead to some weakness in the yen, given that, again, at the end of the day, the extent of the move in yen will depend on shifts in market expectations around Bank of Japan policy.
Number 5. Marjabin expects the Bank of Japan to be cautious for now, with the new PM unlikely to be formally elected by Parliament and sworn in until later in the month.
We continue to expect the next rate hike for the BOJ to take place in January, just on the back of, again, there's a lot of political and fiscal uncertainty in the near term, and maybe the Bank of Japan may be cautious despite the data supporting a little bit of a hawkish stance.
Marjabeen Zaman there. Now, in our deep dive interview, ANZ Senior Rate Strategist Jack Chambers explains where Australian inflation has risen.
There's a few components. One is around the housing sub-component of inflation. There's a few facets to that. One is just the roll-off of the electricity subsidies and rebates from the government. That has electricity prices rising 10% in the quarter. Now, we knew about that component. Where there's been a bit more strength is actually in the cost of building new dwellings. That had been, or the inflation in that component had been relatively low, but it's shown signs of rebounding. Essentially, as the housing market started to reaccelerate, as we saw with last week's data with September house prices, dwelling prices accelerating, we're starting to see builders able to sort of rebuild margins a little bit more, and that's flowing through the way that we measure housing prices in Australia. So that's really adding. And then we're just seeing a bit more inflation across a lot of the different subcomponents. So it's not narrowly defined. It's just a lot of prices are rising a bit more than we previously expected, and that's just boosted that forecast. And we actually think there's upside risk to our 0.9. Essentially, a 1 is more likely than a 0.8, which also goes into the RBA view.
And just looking at some of the details within that CPI forecast, could you tell us a bit more about food prices?
So on the food side, we expect a relatively robust rise. There's a bit of a change in the components there. Things like meat and seafood are up quite a bit in the quarter, whereas some of those egg shortages that we had from the avian flu outbreaks in Q2, that's actually receded. There's been a bit more egg supply, which has dragged down prices. There's a bit of a change there. What you see in other components, though, is things like alcohol and tobacco. They are rising quite rapidly because some of the indexation that occurs on tobacco prices occurs in Q3, which has added quite a bit to that sub-index in the overall inflation basket.
And just looking at travel and accommodation, there's some extra pressure there and some particular events.
Yeah, so the British and Irish Lions tour had a very significant impact there. It really boosted prices, domestic airfares and tourism in general, the cost of tourism, particularly at the start of the quarter when the tour was occurring. That's dropped off when you look at the monthly profile. In aggregate, it will be enough actually to boost the quarterly measure quite significantly. So that's a quirk. That is probably a one-off impact. British and Irish Lions don't tour Australia every quarter, but it has a significant effect. It moves the distribution of price rises higher. That's also why we think there is a bit of idiosyncrasy in how much prices are rising. We think that 0.9 will end up being a bit of an outlier compared to the surrounding points. It's not like we're getting a 0.9 and expecting another 0.9 thereafter, which is why we're still comfortable the RBA will ease going forward. There are a few one-off sort of things which tell us, yeah, this won't sustain. This isn't signaling a re-acceleration in the inflationary process.
And inflation with fuel and transport costs, what's the story there?
So the increase in transport prices mostly reflects the combination of higher fuel. Ultimately, that component of CPI just generally tracks oil prices, and we saw that oil prices were a bit higher on average Q3 than Q2. So that has a pretty easy transfer through. We also saw things like urban transport fares were higher in the quarter, just because there was a bit of an increase in public transport fares in Sydney during the quarter. So you had certain mechanical things like indexing public transport fares, as well as just the general pass-through of oil. From here, we think oil prices are going to be a bit more steady. So you won't get that continuing increase in the the automotive fuel contribution.
Jack Chambers there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, October the 6th. Catch you tomorrow with a full preview of the Reserve Bank of New Zealand's expected rate cut on Wednesday. Will it be 25 or 50? This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.